term.
Welcome to our first quarter overview. We're going through our flex assets. Maybe we'll come up with a fancier name at some point, but right now we call them our industrial flex assets, and it's kind of this unique space of typically drive-in doors that we're creating. We're adapting a lot of space to be useful in this environment, but we always hear different names of what it could be called, whether it's shallow bay or whether it's industrial flex, or there's not a great term for it, which also makes it a little challenging to find like what is the other least comparable information on it, because it's just a much smaller segment. We have some data points. When we look at the market as a whole, we see that shallow bay is like 17-20% of what we call the whole warehouse storage industrial type market, at least here in Atlanta.
Right.
So,
yeah, and this is that mix of office and warehouse. So give or take 30% office, give or take 70% warehouse, but that varies widely depending on every suite. It could be 10% office, it could be 60% office. And you get very different users. But that's the beautiful thing about flex, is that it's in very high demand because you have that flexibility of use.
And very different spans, very different ceiling heights. So it's pretty wide open on what it is. But
well, there's two consistent things. One is there's always a roll-up door per suite. And two is that it's a lot of your limitations on who you're going to lease to are going to be limited by your clear height. So the buildings that we're buying, the buildings that we're seeing are at the highest. They're in the 18-foot range, which when you go to kind of true industrial, you're looking at 30-foot plus ceiling heights. Yeah. So, for forklifts, et cetera, to go in and out of there.
Yeah. So we call our industrial flex, we have about 1 million square feet of spaces that are mostly adaptive things that we've purchased, divided them up into different suites, added roll-up doors, and leased them out. So we're going out and trying to find what's that market information out there and how has that performed. So right now, the information we are seeing, the shallow bay flex is around 4 to 5% vacant. So very well occupied in the commercial space, whereas more traditional industrial warehouse is a little over 10% now in our markets here in the Southeast, because, they have built a lot of it.
Yeah, so in the industrial, the building process is, you call it a 3, 4, maybe even 5-year process. So if the market changes like it did about 2 years ago, it's not that the new deliveries just automatically just stop, right? They're still delivering starts that started in 2022. So for example, like this year already 2 million square feet has been delivered, with an intention of delivering another 8 million square feet in just Atlanta alone. In a rising vacancy environment, rents are still climbing a little bit, very marginally. They expect rents to go down a little bit with the rising vacancy, but the industrial market is seeing a lot of softening right now, but flex is not, and that's predominantly because there is no new flex. Literally, we cannot find any new information about flex buildings being developed or new starts in the flex world.
Yeah, and our typical asset, when our flex is going to have a sub 10,000 square foot unit. That's like our go-to, like under 10,000 square feet. Of our 1 million square feet, we have 148 units, and 122 of them are under 10,000 square feet. That's like our bread and butter of what we're looking at. And not a lot of that stuff being, we really can't find anything being built that fits that bill for what we're trying to find and lease.
Mm-hmm.
But when we think about just all the markets, so we're looking for this type of an asset between like Chattanooga, Charlotte, Columbia, South Carolina, and then obviously here in Atlanta. That's kind of our core area that we're looking at. And of all of those, really Chattanooga has the lowest vacancy.
Right, it has the strongest occupancy. They're seeing, and they're also seeing the lowest amount of new deliveries percentage-wise compared to the major markets like in Atlanta, like a Dallas, like a Charlotte. So lowest vacancies with the least amount of new supply. So that led us to start thinking, man, we should really start hunting more in Chattanooga for this product type. And fortunately, we've come up with a new property, and we're excited about it. And we're negotiating the contract right now. We'll be able to share it with all of you, over the next probably 2-3 weeks.
That'll be a good one, because it's in a great market. We've always liked Chattanooga. It's been always been a little tricky to find stuff that works perfectly for us, but we're excited about that one. Mm-hmm. So yeah, we'll have more information out on that one. But that looks like our flex portfolio as a whole with the market still being very strong for this type of asset, sub 10,000 square feet with a roll-up door with an entrance door. So that's kind of our go-to. Our stuff has been performing really well. So this year for 2025, but for the first quarter of 25, our revenues are up 16% from Q4, and most of that comes from we have CAM that comes in there, but most of that comes from new occupancy. So we added 52,000 square feet of occupancy in the first quarter. We have another 33,000 that's signed with move-in dates in the second quarter. So that's really driving our revenue is that leasing space. We still have about 200,000 square feet of space that is vacant. And it's kind of like, well, how's it going well if we have vacant space? And it's like, we keep trying to find more vacancy that we can purchase and then lease out.
Right. I mean, for example, we closed on the Hub last fall and, basically bought 150,000 square feet of vacancy. And I think I had 30,000 square feet occupied and about 150,000 square feet vacant. And so, we've actually done really well with leasing some of that vacancy. I would say way ahead of plan, but that wasn't necessarily the plan. The plan was to really take it down, renovate it, similar to the Forum that we're sitting in here today. And if you look at the Forum, we've been mostly vacant, 60-70% vacant for 18, 24 months, and now we're working on our last lease and we're negotiating the final terms of it.
Yeah, our game plan on a lot of these multi-building adaptive use flex spaces is we take the existing tenants and try and consolidate them to some of the buildings, see how we can do that. So then we can get a fully vacant building that we can then basically go to town on, get the thing converted into the flex use. So we did that at the Forum deal. We consolidated existing tenants into one building. We had a whole other vacant building that we could then divide up into all the suites. We've leased, that's 6 in there. We've leased those 6. And then we have one vacant suite at the other one. And we leased that one as well. So that brings the Forum deal to kind of the closure of being fully leased. And now getting everyone in and getting them to pay rent is the next part of it as well. Critical part.
Right.
that part of it.
Yeah.
But that's what we're doing. And we're taking a similar approach at the Hub. I mean, and it's really, that's our playbook on this. Where we leased earlier this year, we leased to FEMA. That was over the summer, and then we did an expansion with them. So we had a 30,000 square foot, and we added a 20,000 square foot lease on that asset there. But now we have one fully vacant 80,000 square foot building that we can go to work on, and not in the first quarter, but in the second quarter here, we got some of our first permits set up for that thing. So we are going to be starting swinging hammers soon on that one. So very excited about seeing what that looks like as we carve up the first 3 suites and get them live. Once we can get all the paperwork and once we can get everything going and like swinging the hammer is almost the easy part, we can make that stuff happen pretty quickly.
And the key thing is, when we have that whole building, we can really take that building all the way down and kind of bring it back up. But the key is, building these 3,000 to 6,000 square foot suites in the right division to get a roll-up door, get some office frontage, make sure there's bathrooms and offices and conference rooms, just like you would have in a standard suite. But really white box them is what we call it, and make sure they have enough warehouse space. And that's exactly what we did at the Forum. And as soon as we finished, they leased immediately. Yeah. And again, I think we had I think we roughly had 8 suites here that we had to lease, and we're working on the last one right now. And we delivered them in the last 6 months. So all of them were really leased in the last 6 months.
Yeah. So we look at, we leased 52,000 square feet in the quarter. And the next common question we always get is like, okay, who's signing the lease? What is it? So we had, and it's always interesting. It's always a diverse group of companies that are coming in and taking the space. So this time we had a hospice care center, which home health care is a pretty enormous industry, a pretty huge market. So we had a home healthcare group that came in. We had a funeral services group that came in. We obviously signed FEMA. They did their expansion. We had a plumbing company, an HVAC company. So we have, kind of runs the gamut of things that have moved into the space and taken that. And this quarter was 52,000 square feet that we were able to sell.
I mean, even if you come here to the Forum where we are in Peachtree Corners, if you look at the parking lot, we have a training facility. We have our office. We have a pest control, right? I think we have a pharmacy, right? Yeah. And then in the other building right across the way, we have a Nanolume is a phenomenal tenant. They build giant flat screen TVs for like the side of like stadiums.
It's a big flat screen TV.
Right. And I'm a flooring company, and we've talked to churches, and
Microchip is the other tenant that's over there. So
yeah, so it's a very diverse mix, which is kind of goes back to the point of its flexible use. That's why it's in high demand. Vacancies continue to hold at kind of an all-time low.
Yeah. So we talk about just our occupancy as a whole. Mitch, we got about 200,000 square feet that is vacant in the portfolio, and some of that comes from segments where we have 15 to 20,000 square foot boxes that it's like, okay, do we divide this up or do we lease it as is? And on some of these, we've been trying to lease them as is. It's obviously a much bigger tenant than we're typically dealing with. We only have 7 suites that are over 30,000 square feet. So the bulk of our stuff is on the smaller end. 50,000 square foot tenant is way different than a 5,000 square foot tenant. So in that conversation, but deals like Pleasantdale, we have 30,000 square foot vacancy there that we've gone through a couple different negotiations on getting someone in there before we say, okay, hey, we're fully just dividing it up, right? So longer conversations, and that's really been holding that one with some vacancy. Same thing with our deal like Davis Circle, where we have a great tenant that is there. We had a challenging other tenant that we worked through and trying to see like, okay, does this tenant now want to expand and take that full space? But they're going to be a single user in a full building. It's a longer conversation. So we're still working on finalizing that one. That's one of the vacancies we have too.
And a lot of our tenant turnover is really not coming from a tenant leaving because they're going for some alternative options, or we're begging them to stay. It's that like Davis Circle or at Pleasantdale, these tenants were paying $3 or $4 a square foot, and when we go to them saying, "Listen, like we don't need you. If market's 12, we'll work a deal with you. We need to just be say 9.50, 10. Let's work something out together." And they just can't do it, and there's no other place for them in the market to go. So a lot of times they really just go home and try to operate kind of online instead of out of office space. Yeah.
Like the rental rates are definitely like they're in the mid-teens is where we're getting to on most deals, where our base rent is in that call it 10 to 13 range, and then there's $1 to $3 in CAM depending on what the deal's looking like. So another key part of this is we always want to assess like how much vacancy can we have at one time, right? Because we want to be able to work through it and we want to be able to lease it. So with the roughly 200,000 we do have, we know we've basically pre-leased, or we'll have another 33 that comes offline in the second quarter as those tenants are moving in. So, and then our target is really we want to be able to lease another like 30 to 50,000 square feet going into the summer and really work on getting all of our stuff out there at market and turn it through it. So that's a lot of leasing effort that has to happen, and we're very optimistic in this space. The vacancy rates that are out there are good. The rental rates are good. There's no new supply coming online really to do it. And then also the amount of people that are willing to take a space and really divide it up, not necessarily on a whim, but as spec, there's not a whole lot of that either. Right. So our typical go-to plan is we're taking the support beams that are in the building and being like, hey, that's the footprint we're going with. We want to make it as efficient and easy to do as possible. But really, we're looking at going into the second quarter leasing, charging like 30 to 50,000 square feet of new space that we're able to lease this coming quarter. That's what the goal is there.
Right. And going back to kind of this, the existing tenants and some of the turnover we're seeing, some of our assets we've had for a couple of years now, let's say Covington or Top Notch, and we're now seeing some turnover. Well, that's not turnover on new tenants that are coming in. That's turnover on tenants that we inherited from 3 years ago when we bought it. Their leases are coming up. They were paying $7, $8 a square foot. Market's at 10 to 12. When we go back to them and say, hey, let's split the difference, they're not willing to work with us. And we decide to let the space go vacant. Let's turn it over. Let's get full market. And the long-term benefit is tremendous. The short-term impact is that we have a little bit of vacancy. So Top Notch and Covington are seeing a little bit higher vacancy than I would say that the market shows, or than they would typically have, just because we're cycling through leases that have been there, since before we bought it.
Yeah, Top Notch, like that one has some leases that are really low. They're in like the 3 kind of range. So going from 3 to say, hey, 13-ish, that is quite a leap.
Right.
That sometimes works, sometimes doesn't. But our business plan there, we need to stick to it and go for the rental rates that are there. That is the market. Covington, I mean, yeah, we're 85% there. We have 2 suites that we should be leasing those up in the second quarter. But yeah, it's like we need to hold and we need to go get our market rents that we projected and that are in the market. At Covington, it was more like slightly higher base rents. So like, hey, they should be in like the $12 to $13 base rent with CAM above that, which is great, strong leases. If we look at other sides of the industrial, the warehouse, or their rates are half that, right, that are out there. So we're seeing really good rates. It's really what's in the market as well. And again, with not a lot of supply come online, it's a pretty good spot.
Exactly.
Yeah. So one thing we look at is in our operations, like how do we make distributions? We have our reserve strategy that we're going with, but anytime we do have one of these, like if we have a lot of turnover, it's going to boost the reserve calculations we have, and we have occupancy, or if we have vacancy tied to that, then we're going to want to hold cash so we can make sure we can turn all those things. In a few instances, issues we run into on that are, we kind of talk about like we're going to take an asset and flexification, turn it into this space. Well, we've had some tenants come back to us and like, hey, this looks great. We'd like to turn this into medical. And we're like, okay, we have the parking to do it. The zoning would allow it to happen. But that's going from, hey, we're looking for a tenant that's like, this is good. We're going to move in. We can move in this month and build out some stuff, to we want to spend $100 a square foot building out a medical user. It is a good tenant. Medical is always a good tenant. It's just sometimes that cost is outside of the scope of anything we can realistically do. We've had that a lot at Lakeside Flex, where we went in full target on doing our flex bays, and we've just had a lot of medical interest. We quite frankly, like we can't be spending $100 a square foot there.
Well, it wasn't one of the tenants like they were asking us to spend $100 and they were going to spend an additional $200.
Oh yeah, they're going to spend even more.
Yeah, it was going to be like a $300 square foot build out on a single story office warehouse building. We're like, that's not the right fit. It's yeah.
So there is a world in that could work, or we're still engaging, we're still going through that conversation, but it's like doing a flex to medical transition is definitely expensive. So we're going through and we're seeing if we can make something work. We'd get there and we'd figure it out, but it's a lot.
Right.
So they're there, but it's kind of just like, oh, that's a lot. Yeah. It's definitely a challenge on it.
Right.
So, but Lakeside, for example, we have one suite that we white boxed over there that we've had 2 medical groups interested in. Ultimately didn't work, but it's over 10,000 square feet. So like it's a big space, and anything you do where you start getting into, lots of dollars per square foot times 10,000, like then it becomes a lot more.
It's a real number.
Right.
Yeah.
So, but overall we're seeing really strong demand. We had great leasing this quarter. We're teed up for the second quarter, and we really want to see another like $30,000 to $50,000 quarter that's coming in for the second quarter. That's what we're going to be pushing for with our teams. So, on the debt front, like I mentioned, we're looking at a deal. So we're looking at buying another one here that's up in Chattanooga, which we're excited about. But on the other front, like we don't have any refinances that are in the immediate horizon. That's always a big part of what we're looking at, is like, is there a loan that's coming up, and do we have to go out and shop that loan, or is this something we're taking to market to assess where our values at? We don't have any of those coming up right now.
And all of our existing loans are fixed rate. So we're really don't have a whole lot of exposure to the interest rate movement and environment right now. And frankly, as these deals stabilize, we're keeping a close eye on the market, that if there's an opportunity to basically get a new loan at a lower interest rate, we'd happily do it.
Yeah.
You're
always watching the 10-year go shenanigans all over the place. But if we can find a point in time where we can jump in and do it, we're going to do it with the deal we have. So we're always looking at that front. Just we don't have anything right now that is coming up from that standpoint.
Yeah, unfortunately, I mean, lenders have been pretty soft in the space. We've been looking at a lot of new assets, in the Atlanta market. A lot of them have loan assumptions that we can look at. Several we need to place new debt on, and the debt terms are so soft right now. It's really making it hard to justify kind of the whole story of the deal, and justify the future underwriting of it.
Yeah. The other part where the question of like, hey, is there distress in a lot of these things that we can take advantage of and buy? And we're not necessarily seeing there's no real like, hey, there's distress out in the market, and you can go pick stuff up at a song and get a great, fantastic, underpriced, you're stealing the kind of deal thing. That's not what we're seeing in the market in any of our segments we're operating in.
Yeah, I mean, specifically in this flex or single story office space, we're seeing a lot of deals come to market in the kind of 70, 80% occupancy range. But what the price that they're expecting is just beyond the affordability to take that property to full, the fully lease or full lease or full flex. And as a result of that, we're just the spread between the bid and the ask is just too far apart. And we're not seeing anything transact. I mean, especially in the Charlotte and Raleigh-Durham area that we've been bidding on a lot of stuff. We're off by give or take 30%, and they're just not even trading. The ones in Atlanta were off by 10%, and those deals aren't trading.
Yeah, still holding.
So, we're being patient, keep an eye out for things. This deal in Chattanooga was kind of a perfect fit. That it was on the market, kind of got dropped a couple times because of lenders. And we were able to swoop in as like a third or fourth place person. And
it's been the story of our
performance.
Real estate investing career.
Yeah, exactly.
Solid third place bid.
Yep. Just like your prom, right?
Yeah. But yeah, so no, we're excited about that one though. So overall, I mean, end of quarter, all of our stuff goes out on the 20th of every quarter. So all of our statements will be in the investor report on the 20th. All the distributions go out on the 20th. When we look at our distributions coming in on the flex asset side, it's mostly deals that we've owned that have maintained occupancy. If we're doing a turn, obviously the construction stuff we're going through, those ones, we're still months out from when we stabilize. Because even like the Forum, done with construction, tenants are moving in, they still have a few months before they're fully paying. And then we start making distributions on that one. But I mean, Forum, we're teed up to do that. Hub will be following in the next 12 months as we get through that process as well. But on the previous stuff we own that is occupied, we're looking at if it's over 85% occupancy, we're able to hit our cash flow numbers, make distributions, and those will all go out on the 20th. We're also doing our live Q&A, which we do every quarter. If you want to sign up, we can go through any of the really like nitty gritty, like get into the specifics of a deal. We love talking through that stuff. So that'll come out to register for those as well. Hope this was helpful. That's our overview for what we call our industrial flex asset class. Thanks for watching.